Hello, ladies and gentlemen, boys and girls. Today we are going to see some basic things about budget calculations. We have some basic concepts that we need to look at. We have things like capital receipts, capital expenditure, revenue receipts, and revenue expenditure. Now, a receipt is something that is incoming money, and an expenditure is something that is outgoing money, right? And the capital part of this means that any incoming or outgoing money that is going to affect the asset and liability structure of the government. And this is where we invest in future capacity building. On the other hand, the revenue side of things is day-to-day operations, which is recurring in nature and costs involving basically maintenance and all those things. And it doesn't affect asset liability structure. Now, if we look at capital receipts, these might come from disinvestments, where the government is selling its stake in PSUs. Then there are loans, the money that the government borrows, because in the balance sheet that shows up as a liability, right? Then recovery of loans. All right. Next is capital expenditure, where the government might be lending money and paying back loans, basically principal amount, and infrastructure creation. So that would amount to capital expenditure. Next, revenue receipts can be tax revenues and non-tax revenues. Tax revenues would be income tax, corporate tax, GST, etc. And non-tax revenues can be fees, fines, interest on loans government has given out, and dividends from PSUs, any spectrum auctions, telecom licensing fees, all these things. And the revenue expenditure that the government has to make are salaries it gives to its employees, pensions, interest payments on debt, subsidies, and operational costs. Grants also come under the revenue expenditure, even if the recipient is using them to create assets. Like if the union government is giving grants to a state and the state uses it to create a capital asset, still it would be a revenue, it would show up as revenue expenditure in the government's balance sheet. Now, the major important deficits that we need to be aware of are, first of all, fiscal deficit. This is the overall gap in the money that the government has. It represents the total borrowings that is required by the government, and this can be total expenditure, whatever the government is spending, minus total receipts, excluding borrowings. Basically, what it's earning, the gap between what it is spending and what it is earning. And we are excluding borrowings because the borrowing itself is a way to finance this gap, right? And so, in other words, we can say that this is total receipts is revenue receipts plus non-debt creating capital receipts. All right. Now, next is primary deficit. Now, what this primary deficit measures is how sustainable the current spending is without the burden of past loans. And therefore, we remove any interest payments that we are making on the past loans from the fiscal deficit, and that gives us the primary deficit. Next is revenue deficit, which is revenue expenditure minus revenue receipts, and then effective revenue deficit, which is revenue deficit minus productive grants, which are grants that build capital assets. This one right here, right? Now, fiscal deficit by itself is not bad by default, but high capital expenditure can be good. That just says that the government is spending more on creating capital assets, and so it is growth oriented. High revenue deficit is bad. That would mean that the government's revenue expenses are more than what it is earning, and therefore it is spending more via borrowings. And revenue spending does not create any assets, and so that it is spending more and earning less and spending the money it borrows, and the borrowings are not creating any capital assets, so that is bad. Now, let's see some examples. So, in this question, we have revenue expenditure is given to be 80,000 crores, revenue receipts are given to be 60,000 crores, and the government budget has borrowings which are 10,000 crores, and the interest payments are 6,000 crore. Now, which of the following are correct? Now, revenue deficit is nothing but revenue expenditure minus revenue receipts, and so that comes out to be 20,000 crores. So statement 1 seems to be correct. Next is fiscal deficit, which is nothing but the borrowings that the government has to make, and so the second statement seems to be correct. And the primary deficit is nothing but fiscal deficit minus interest payment that the government has to make on the previous debt it has taken. And so we have fiscal deficit of 10,000 crores minus, what is this, interest payments of 6,000 crores, that comes out to be 4,000 crore. And so this seems to be correct also. So the answer is D, 1, 2 and 3. Another one, the country's fiscal deficit is given 50,000 crores. We have it is receiving non-debt creating capital receipts of 10,000 crores, and interest liabilities is 1,500 crores. So interest payments are 1,500 crores. What is asked is gross primary deficit. So primary deficit is nothing but fiscal deficit minus interest payments. Fiscal deficit is given 50,000 crores. Interest payment is 1,500 crores. So the answer is 48,500 crores. This additional detail seems to be just useless. All right. So this is the basic of budget calculation.